Dividend investors, bonjour. This is Mike Yeru, founder of Dividend Stocks and passionate investor. Today we're talking about one of my favorite topics, leveraging. This video is all about borrowing to invest. While it could be applied for everybody, I have put all the content for Canadians in terms of stocks and strategies, mostly because there's something that doesn't exist in the US, which is called the Smith Manoeuvre, where you can make your interest on your home tax deductible. Obviously, it's already it's already something in the US, but in Canada, if you have a mortgage, you have to pay your interest, and they're not tax deductible. And the only way you can do it is through the Smith Manoeuvre. We're not going to go into the specifics of the Smith Manoeuvre today, but we're going to talk about how to build that portfolio. So there's plenty of things that you can read about how to set up your Smith Manoeuvre, but most of the time the investing part is not the focus. The focus is on tax implication, right? So once you get the point where you borrow to invest, you have interest, and then when you make revenue from dividend or from interest, you can apply those interests back on it, so you can save some taxes. Once that setup is done, you're left with the confusion of where should you invest your money. So today we're going to talk about how leveraging works, how you can build a portfolio. I'm going to show you a complete example of which kind of like dividend growth investing portfolio I would use for a Smith Manoeuvre strategy. Obviously, during this video, we're going to talk about lots of stocks. Those are not buy or sell recommendation. I am not your broker, so please do your own research, your due diligence, and make sure that everything fits with your risk tolerance and investing strategy. And at the end of the video, I'm going to invite you to join our community throughout the workbook that we have launched. Free workbook. You're going to get the link at the end so you can download it and go a little bit further in your investing journey. So now let's start about borrowing to invest. This sounds risky, right? So you're already in debt because you have a mortgage and stuff like that. And then we're adding another component. We're adding that component of risk where you're going to borrow more money to invest in the stock market. So the principle is quite simple. It's all about making more money with other people money. When you look at it, if you're able to pay an interest rate of 3% and generate a 6% return, well then the 3% difference on the between the interest you make and the return that you generate will be just profit in your pocket. So this is the perfect condition, right? And one thing that is very important is even from time to time, we know market fluctuation will hurt your portfolio. So one day maybe you will not get that 6% return. However, if you can at least make the same amount as you pay in interest, the compounding factor will work out. So let's say you borrow $100,000 at 3%. This means that every single year you pay $3,000 in interest. What is great about it is it's not compounding. So every year, that's the same $3,000 that you're going to have to pay because you still owe $100,000. On the other side, if you invest $100,000 and you make 3% return, at the end of the first year, you don't have $100,000 to invest, but $103,000. So year after year, those interests will compound, those returns will compound, and you will eventually make more money. Obviously, the goal is not to generate 3% with a leverage strategy, especially if you're using the Smith Manoeuvre. This means that you're borrowing your money against your house. So I want to make sure that you leverage for something. So you're looking at the long-term investment horizon. Obviously, in an ideal world, you'll have to get a 100% equity portfolio to make sure that you maximize that return and you reach a 6, 7, 8% return over it. So you must have a high risk tolerance. Those kind of portfolios are obviously not linear. So every single year, you're not going to make that 6%. So one year it will be 15, the other one it will be -5. And in the end, it will equal to a good return that is like high single digit. You also need a solid budget because when you think about borrowing to invest, you must always remember that one part of the equation is that you have a loan and the market could crash, you could panic, you could make bad investment. And at that time, you want to make sure that you have the good paycheck, or you have enough liquidity or the capacity to pay back that loan without your investment. In an ideal world, it's not going to happen, but we all know that sometimes it's not working the way we thought it would. So the perfect leverage portfolio would be 100% equities to make sure that you maximize your return. And you want a combination of growth and income. Why you want that is because most of the time when you borrow, especially in Canada, the interest is tax deductible against the revenue you generate from your portfolio, but not capital gain. So that's the problem if you're just going to small cap and tech stocks that paid no dividend. You won't be able to benefit for the full impact of using the interest as being tax deductible. So what you want to do when you build a Smith Manoeuvre is you maximize the companies paying a dividend, because all that dividend that is being paid, even if it's being reinvested year after year, it will be taxable, so you can use your interest against it. The point of having dividend paying stocks in your portfolio will also help you to have a relatively stable portfolio. Most companies that are able to pay a dividend and grow this dividend will be a little bit more mature, will show robust financial history. And those are the characteristics that you want in a company to make sure that they will go through any kind of recession. Remember, we have a long-term investment horizon on this one. So obviously, you're going to run into some bull market and you're going to hit some bear market at the same time. So the portfolio models should be well diversified, because you want to make sure that you don't focus on a specific sector, because if you're wrong, well, then you're borrowing money to be wrong, and then it makes a very bad investment. So this is why I suggest not go for more than 20% in each sector, and you can go for various subsector. For example, if you pick the industrial sector, you can go for railways and then defense, and then you can look at industrial parts, and those companies are not interlinked together. You can think of REITs the same way. So you have retail REITs, but you also have apartments, offices, industrial, distribution center, cell towers, data centers. So they're all subsectors of the same industry. So this is why you can sometimes go a little bit over 20%, but in an ideal world, I would never go over that. You can aim at like 5 to 10% per sector, and then your favorite one at 20. I think 20 to 30 stocks is more than enough to have a well-diversified portfolio, and you want to make sure that you have full control over it and it's easy to follow, because you're going to follow this portfolio quarter to quarter to make sure that each component plays their part, each company meets your investment thesis. You obviously don't want to duplicate holdings. What I see often for Canadian investors is they will hold like 4 or 5 Canadian banks, and then 3 telecoms, and then 5, 6 utilities. You know, they're all playing in the same playground. So if you own Bank of Montreal, and then Royal Bank, and then TD Bank, and then Scotiabank, and then you're thinking, oh, maybe I should add National Bank to the lot, you're not diversifying. You're just like duplicating the same holding over and over again. So you're better off selecting your 2 favorite Canadian banks, because I know that everybody loves them, but pick your 2 favorite and then move on to another sector. It is time to rethink your sector allocation in terms of having a long-term strategy that wants to generate a maximum return. So your core portfolio should be focused on tech stocks, finance, and probably healthcare. Consumer defensive, the problem with them is sometimes they don't show a high yield. So you don't want to have too much of those in this portfolio, because you want growth and you want either high growth or higher yield. However, those sectors will be a good base for any portfolio. Then you want to probably go a little bit more towards growth. So we're going to select industrials that are usually highly cyclical. So the thing is, they don't grow super fast, but you always have opportunities to pick up some subsectors in this industrial industry where they are like strong bearish trends that everybody's like, nah, you know what? It's all gloom and doom over there. Let's wait for a while. So this is your chance to pick up great companies like railroads, for example, that will thrive in the future. Then you can add consumer cyclical, because obviously when the economy thrives, consumer cyclicals are thriving at the same time. You can add a little bit income component throughout REITs, utilities, and telecoms. Especially in Canada, we have very strong companies in those sectors. So it's great to have kind of like a good base there that will generate a 4 or 5% yield. That will increase your overall portfolio yield, which is good because you want to have you want to use those interests to be tax deductible, so you want to apply them on your revenue. I would ignore the energy sector and basic materials. I know a lot of people are a fan of oil and gas, and then others really like gold. But in this case, they usually make very bad dividend growers. When you look at throughout the history, the thing is, those two sectors are highly dependent on commodity price. And whenever it drops, it hurts their cash flow, and they're not able to pay a good dividend at that point. And this is not what you want when you build a leverage portfolio. You want something that is relatively stable and aim at growth. So you're better off with other sectors that will give you both a great combination of capital appreciation and dividend growth. Now, sector allocation is key. This will be responsible for most of your return. The example I'm showing you here is what I would build as I have, if I would have to build a leverage portfolio in 2020, this is how I would do it. So as you can see, I have like various sector, and the largest one are consumer defensive, consumer cyclical, and industrial, which is pretty much the core of my portfolio. And then I have utilities at 14, I have technology, real estate, and financial services at 9, and then a small play on energy. I know I told you to ignore that, but you'll see when I describe each stocks in this portfolio, you'll understand why. But basically, do not focus on that part. This will not help you over the long term. Now that you have set up your sector allocation, it's time to find those hidden gems. It's time to find some interesting picks and add them to your portfolio, right? Buying is simple, yet it's difficult. A lot of things in the world are very, very simple, but they're very difficult to apply. A couple of years ago, I decided to quit everything, my life in Montreal. I hopped on a small RV and I went all the way down to Costa Rica. So we drove to Canada, to the US, and then to all Central America, spent 3 months in Costa Rica, and then we went back. So technically, this was very simple to do, right? You just rent your house, you buy an RV, and then you start driving. But in reality, it's a lot more difficult because the process to get there was complicated. The process required me to work longer hours on a side business to make sure that I have money. Then to make sure that we have a school program for our kids because we were homeschooling. And then we needed an itinerary. So we needed to work consistently for several years before that product took place. If you want to lose weight, it's pretty much the same thing. Eat less or eat better, and then do exercise. It's quite simple, but most people have a hard time doing it because being consistent over and over and over, this is what makes it so hard to achieve. Well, investing is the exact same thing. It needs consistency, conviction, and you must take action. I like to think that it's 45% science, 45% arts, and 10% magic. And the 10% magic is not being lucky, but the magic is when you pick up the right companies, then they thrive, and then you hold on to them, and at one point they will show a 300, a 400, a 5% on return, which is crazy. But this is the magic behind dividend growth investing, is once you pick the right companies and you let them ride, 10 years down the road, you're going to have amazing results. So what I'm doing as a first screener is I'm using the dividend triangle. This is one thing that I've kind of created myself, and the concept is quite simple, but it just gives you a very strong base to any stock filter. So basically what you're looking at right now is Royal Bank. So we look at the revenue, the earnings per share, and the dividend growth. So basically what you want here is to have the three sides of the triangle, revenue, earnings, and dividend, to grow roughly in a similar manner. So you can see that it's quite stable, but then you have those big drops right here at the beginning of 2020. And this is an invitation to investigate. You need to understand what happened over there. So you see that the company was doing amazing until 2020 happened. Well, obviously, you all know here that it's due to the COVID-19. There was an economic lockdown. All banks had to increase their credit for provision for losses. Their revenue were down because interest rates were going down as well, so it was hard for them to make it happen. But you get the idea of you want to have companies that basically are able to grow their revenue because they're leaders in their market, they have innovation, they have strong market shares, strong brand recognition, innovation, and so on. And then those companies that are increasing their revenue and their sales year after year, well, they technically should be making more money at the same time. So control of margin, control of costs and expenses. You want to make sure that those businesses are making profits. Yes, you can play around with earnings because it's based on general accounting principles, but over a long period of time, money is money, and at one point in time, it will show on the income statements. So once you have found those leaders in the market making money, growing their business, and making it profitable, well, technically they should share their wealth. And if they increase their dividend at the same time, well, then you have companies that will be exposed to several great factors as any investors will look to have. So we're talking about robust financials. We're talking about a very good balance sheet, strong cash flow generation, because if you don't generate strong cash flow, you can't increase your dividend. You know, everything goes around this dividend triangle. So it's a very good step one for your stock research. Then you have to go a little bit further because only 3 metrics will not make you a rich investor, right? So in this case, you want to focus on dividend growth, especially when you leverage, because, you know, it's fun to think about how it could do well, and then you could generate 10% return every single year, and then you can double your money while you're borrowing that from the bank, and then you're just going to end up richer. But you also have to think about the downside. And the downside is we hit a recession or potentially a depression. And then especially in the time of the recording right now, we're in mid-2020. The coronavirus is not gone yet. The market has recovered, but interesting enough, the economy hasn't. So we're kind of like in a blurry situation. So you want to make sure that you pick companies that shows a strong dividend growth profile and forget a little bit more about the yield. I know it's very tempting to buy those companies with like 6, 7, 8% yielding stocks, but those could have lots of problems. You know, a high yield is a red flag. It doesn't mean it's a bad stock, but it's an investigation to go a little bit further and understand what's happening. Even among ETF fans, and if you look at Ben Felix, which he is a portfolio manager at PWL Capital, he's a CFA. Well articulated and a strong fan of ETF investing, and he doesn't like dividend investing that much, and that's fine. But even then, even in his videos, and even when he talks about dividend investing, he tells you that the dividend doesn't matter, and he's right in one point. But he also tells you that dividend growers are technically companies that are exposed to strong factors, such as discussed before, robust financials, solid balance sheet, strong cash flow generation, leadership in the market, growth vectors, and etc. So basically what he's saying is, yes, they're going to outperform the market, but not because they pay a dividend, but because they are strong businesses. And I'm telling you, they are growing their dividend because they're strong businesses as well. So basically, we're kind of saying the same thing. If you focus on dividend growth, you will likely get companies that will outperform the market over the long term, but will have less volatility simply because they're stronger than other companies. It's a great way to find those businesses. Of course, you're going to miss companies like Shopify. But in order to miss a few great opportunities, you're also going to pick among the best basket of stocks, and this will avoid you to making huge mistakes and picking bad stocks at the same time. Overall, we're playing the long game here, and in terms of leveraging, it's not about hitting a bunch of home runs. It's about hitting as much as good, as simple or double as possible. Now, Once you have found companies that shows a strong dividend growth and a decent or a very strong dividend triangle, it's time to look at dividend safety. The dividend safety is basically the ability of a company to sustain and grow their dividend throughout time. So we're going to look at payout and cash payout ratios to make sure that those ratios are in line. In an ideal world, we would look at companies with ratios under 80, 85. Sometimes you'll see payout ratios over 100, and it doesn't mean it's bad. It means that you need to dig a little bit further. If you look at a company like Enbridge, for example, they use distributable cash flow per unit. This is not obviously an accounting number, and you will not find it in the financial statement. So when you do the payout ratio using the earnings per share, it's going to show you something that is out of whack. But then when you look into the quarterly presentation, you'll see that the company is actually showing a very low distributable cash flow per unit payout ratio, and they have plenty of money to distribute to the shareholders, and there's absolutely no problems. So this is where it's important to not put that in your stock screener, but instead of that, and looking at each company individually. Now you also look at the long-term debt trend. So you want to see if it's growing all the time. At one point or another, the company will have to pay it back, and this will hurt cash flow. If it hurts cash flow, it's going to hurt dividend. So you want to understand why they're racking up debts. Is it because they have plenty of projects and it's a capital intensive business, and later down the road they're going to make a lot more money? It could be the case. If you look at railroads, or if you look at utilities, for example, this could be something that's happening. It's less dangerous to have a high level of debts for Fortis, for example, which is one of the best utilities in Canada, than it could be for a growing company that is just racking up debts and trying to acquire competitors and hope for synergies and make more money, but it's not always not always the case. Finally, cash flow from operation trend. You want to make sure that the business is generating lots of money, lots of cash flow, because cash is king, especially during downturns, especially during recession. You want to make sure that those companies are able to sustain their dividend, obviously. Now, if you want to add some REITs, let's take a pause and discuss REITs for a minute. And this could be an entire complete video about REITs, and which I'll likely do it later on. But the point here is REITs will not bring growth too much on your portfolio, but they can offer you a higher yield and some stability. So this is a very good way to build something a little bit more stable in your leverage portfolio through the Smith Maneuver. You want a minimum dividend growth. A lot of REITs are quite generous, but they're offering a high yield with no growth. Well, over time, this dividend is at risk. And on top of that, your dividend paycheck is getting eaten alive by inflation. So you don't want to have that either. You have to make the difference between growth and gluttony. A lot of REITs are either issuing more debts or issuing more units. And when they issue more units, this means that they have to pay more dividend to those unit holders later on the road to finance their growth. So at one point in time, buying more properties, developing more projects is not always a good thing. So you want to make sure that they grow, but if they cannot grow their funds from operation, FFO, or adjusted from operation, so AFFO per unit throughout time, then you have a red flag. You don't want to go there. You want to make sure that the company is growing its dividend growth capacity. Because if not, at one point or another, when we hit the recession, they're going to hit the roadblocks, and then you may end up losing value on the stock price and getting your revenue cut, which you don't want. Subsectors in this industry is quite different. Right now, I would not go for retail REITs, obviously. Apartment REITs are interesting, but you have to be careful because some of them will have a hard time because tenants won't be able to pay their rent. So this is not something that you want to look at. My favorite are usually industrial REITs, because they are more stable and they have long-term contract. And even though the businesses that are renting those facilities have a bad year, it doesn't mean that they will go bankrupt. So over time, you can recuperate your money. It's a little bit easier. Now, you must, once you have looked at those are the metrics, that part was the 45% part about science. Now we're going to move towards the 45% of arts. You need to understand what's happening in this. There's a lot of qualitative things that you need to understand here. First is, if you're not able to explain a business model to a 12-year-old, this means that you don't understand the company completely, and you don't understand how they make money, and you won't be able to understand how they will thrive or die in different situations. So make sure that you write down the business model and that you can explain that to a 12 years old. That's your test. Once you're getting very hyped about the company, now it's time to look for downsides. Every company has risk, and it's very important to understand them, especially when you're leveraged, because you have money at stake. If you're not making money from your investment, you'll still have to pay the debt. So you want to make sure that you understand what could possibly go wrong with each company, and then you can assess those risks and determine if they fit in your portfolio or not. And you don't want to have like a bunch of companies that are reliable on the exact same event or type of risk. And then you can look at the potential upside. Obviously, this is basically how you're going to formulate your investment thesis, why you think this company is going to grow in the future. And don't just tell me, oh, Mike, that's because I like the yield. The 5-6% yield is juicy, it's great. Yeah, that's not a potential upside. That's not making the company any better. That's just a fact. So you want to avoid to go there, and you want to go a little more specific on how the company will grow in the future. Acquisition, R&Ds, innovation, organic growth, etc. Now, once you have done everything else, now you can look at valuation. To be honest, I am not a big fan of valuation at DSR. We use it as a comparable tool among the same businesses in the same industry. But honestly, whenever you hear about a CFA or a financial firm that has developed this incredible and precise and complex financial analyst that will tell you that Fortis will worth $72.43 in exactly 12 months. I'm sorry, but this never happens. They're always wrong because we cannot predict the future. So instead, what we do at DSR, and that's what I would suggest, is to look at the past 10 years of PE ratio. This will tell you how the market values in general the company, and then whenever there's a big fluctuation, you can dig a little bit deeper to understand where the fluctuation is coming from. Is it because the market in general was bearish or bullish? Or is it because about the sector that everybody's rushing towards a sector like the tech sector, for example, or the healthcare sector right now? Or is it because specific to the company, where the company is not doing very well, and then the market is losing interest on the company, and they think, you know what, now they're making profit, but in a few years down the line they won't, so PE ratio starts to reduce? Or as the opposite, the company is about to grow faster than ever, and then they're willing to pay higher for the current earnings. I also use the dividend discount model, also called the DDM. Basically, this is a quick calculation that will give you the price of a stock, the fair value of a stock, based solely on its dividend growth potential. So it's not going to work super well on low yielding stocks. If you look at Alimentation Couche-Tard and you try to run a DDM, it will not likely to work, but it gives you a good idea if you're overpaying or not. Then again, I like to use the DDM to compare companies. So for example, if I hesitate between Royal Bank, TD Bank, and BMO, I will run the DDM with similar numbers, and then it will give me a better understanding of which companies is underpriced or overpriced. So this is basically the point where you decide if you buy the stock immediately or if it's being put on your watch list because you think that there's an opportunity that will happen in the future. Finally, before you pull the trigger, there's one last thing that you need to do that is super important, and it's to write down your investment thesis. The point of writing down all the reason why you buy this company is to prevent you from panicking when the market goes nuts. When in March 2020, the market went down by like 30% in the blink of an eye, I went back to my portfolio and looked at each of my investment thesis for each company. And almost all of them were still showing the same reason, and they were still great businesses. And I was like, you know what? I bought those companies for some reasons, and they're still there, so I'm gonna keep it. And this becomes my reason to buy or to sell stocks. That is super easy to do. So it's nothing related to how much I'm making or losing on the company. It's just I look at the investment thesis every quarter and say, oh, does it meet my investing thesis or not? Good example was several years ago, I bought shares of Scotiabank. And my investment thesis was, you know what? I really like their position in Canada. It brings stability and great cash flow. But they also have the international segment where they develop businesses banking in countries where their GDP growth expectations are a lot higher than Canada and the US. So technically, they should outperform other banks because they're in Mexico or in the Chile or in the other Latin or Central American countries that are growing faster than Canada. So this gives them an edge. And after a few years, I realized that while it was a compelling story, a great narrative, nothing happening. Like Scotiabank was not outperform any banks, and basically they kind of like having a hard time dealing with Latin American style of banking, and they were not doing bad, but they were not doing great either. And for that reason, because the first reason I decided to buy Scotiabank was they will outperform based on their exposure to international markets. It didn't happen after a few years, and then I realized, you know what, I'm better off selling Scotiabank and buying another banks, and this is what I did. It was a lot easier to just think, oh, I'm making money on Scotiabank, is it time to let it go, maybe sell a couple of shares or maybe wait, and then you go into that cycle of doubts and dilemmas, and you don't do anything, right? So instead, I use that every quarter, look at my investment thesis, and take action right away. Now, it's time to move to the leverage portfolio example. In an ideal world, you want to have a dividend yield that would be equal or higher than your interest rate. Right now, the interest rates are very low, so it should not be too complicated. You want to have something that is well diversified across all sectors to minimize fluctuation. We never know when there will be a bull market for a specific sector or a bearish trends for another one. So this is why by investing 10-15% on across several sectors, you're playing it safe, and you're better off selecting the best of breeds for each sector. Then focus on dividend safety, and you must have a growth component because you want also to see this portfolio grow in value at one point in time. So this was the sector allocation I presented to you earlier. I'm going back at it with, that's exactly the same asset allocation. So strong concentration into consumer defensive and cyclical industrial utilities. And then you move towards with communication services, real estate, technology, financial services, and a small play in the energy sector. And I'm going to let this chart there for a little while. Just not going to discuss all the stocks that I've picked here. As you can see, I have a well-diversified portfolio. So it goes from Andrew Peller, Alimentation Couche-Tard, which have very low yield, but I also have a higher yield like BCE, Enbridge, which is my only play in the energy sector, but with a yield at 7.4 and a strong dividend growth history in the past, like 25 or 26 years consecutive dividend increase. So this is great. You have Intertape Polymer at 5.37 as well. And on the other side here, you have some banks. So national banks, Royal Bank at 4.4%. TELUS as well is doing well, and then you have other companies that shows a little bit more growth for like OpenText or TFI International, Jameson Wellness. So you can see that I have built a blend of companies that has like either 1% yield to 7% yield. A lot of them are like 3 or 4%, and in the meantime, my goal was to build a portfolio that would generate between 3 to 4% yield, as expected of paying an interest rate that will be around 3% or maybe a little bit lower. So that was the whole purpose of it. You can screen capture that, look at it. Then again, those are not buy or sell recommendation. Please do your own due diligence, do your research on it. I do hold, as a disclaimer quickly, I hold Andrew Peller, Alimentation Couche-Tard, Canadian National Railway, Emera, Enbridge, Fortis, Intertape Polymer, Magna International, National Bank Open Text, Royal Bank, TELUS, Sylogist. And yes, those are the stocks that I hold right now at the time of recording. Some of my favorite are still there that I still don't hold in my personal portfolio, but it gives you an idea of like which kind of businesses I'm running here. In summary, risk and reward for the leverage investing. You have to understand you have a debt, so you don't want to go crazy and then gamble that money. You want to have like a solid plan, long-term strategy with a combination of dividend and growth. The more dividend growers you have in your portfolio, the better you should perform. You look at something that is well diversified in terms of sector, 100% equity, and you need a straightforward investing process. You don't have to take mine. There are plenty out there that works. I wanted to show you mine in a few minutes. Hope that it makes sense to you. That's a good base. This is how I actually use that's the process I use to build my own portfolio and manage my my money on a quarterly basis. So I hope that it was useful for you. Now, to end this, well, first, I hope that you have enjoyed this video. If you watch it on my YouTube channel, please subscribe and give me a thumbs up. Give me your questions about the Smith Manoeuvre, about leverage investing. It's always welcome. And now I want to offer you to subscribe for free to our newsletter. You can click on the link below this video. You'll get the free workbook. This is the workbook where we're going to teach you from A to Z how to build your portfolio. It could be applied for borrowing, but it also could be applied for a retiree that wants to build income, for a younger investor that is looking for growth. It's obviously all about dividend growth investing, but we adapt in this portfolio workbook. We adapt the questions and we adapt the content to make sure that it can help you to invest with conviction and enjoy your retirement. That's pretty much the whole purpose of this book. Then again, link right there below. I hope that you enjoyed this video, and until the next time, stay invested.